Well, guess what's coming next week, folks? The Federal Reserve's next meeting. So what are they going to do? So I put a poll out on my YouTube channel, so check that out. Put in your vote. Let's see what you guys expect. But we have some news out today. There's only really one piece of information. Well, there's one coming out in just a little bit. It's home sales. But the one piece of the number we're talking about today is inflation. That's the elephant in the room right now. So today's PCE number. The PCE is the index that the Federal Reserve really monitors when it comes to inflation. That's what we're going to talk about next, because we got to figure out what's going on with inflation. Thus, what the heck's the Federal Reserve going to do in the November meeting, and then the December meeting, and then in 2023. So that's our biggest concern right now, or where mortgage rates are going. So with that, without further ado, let's get over to the reporting for today. So today's headlines are: key inflation gauge from the Fed rose 0.5% in September, in line with expectations. So that's good news. Kind of, sort of. But again, you can't judge a book by its cover. So what we want to do is really dive into the details. One we see right here is expenditures for everything kind of went up. Okay. But another piece of the puzzle is compensation to employees also went up. And another area to focus in on that is right here, the personal consumption expenditure. This is actually the gauge, the one inflation number that the Federal Reserve puts their most weight in. You can see through here, May, we're at 6.5. Then June, it spiked all the way to 7. Then it started to come back. So we have July 6.4, August 6.2. For those out there that'll say like, hey, Dan, why are you checking out August numbers? Because we're in October. Well, these are the numbers posted. So what happens is that things happen through the economy, and then economists and the government and everything puts that data together. Well, it takes them some time to put the data together. So usually it's released about 30 or 60 days from the time that they're focusing in on. So that's why the data, it's not I'm using old data, it's the most new data out, but it's just how they do their studies. So that's that piece of the puzzle. But what I want you guys to look at too is in here, personal income rose by 0.4 in September, but spending rose 0.6. So we're spending more than we're actually increasing our wages. So if we have expenses going up higher than our wages, that's not good. And that's called out of control inflation. Okay, so that's why the Federal Reserve is watching all this stuff, because prices are going up, but our income isn't going up in its same increments. So what I want to talk about right now is that's basically the only data that we had today, and it came in pretty darn good. We're seeing that inflation is starting to come back down. So have we peaked? I think we peaked. But the biggest concern now is a recession on the horizon. But what we're going to talk about right now is what I expect from the Fed next week. So let's go over the data that you're seeing on your screen right now. This is the economic calendar. Let's just go and see, is the economy still going on fire? Is it moderating, or is it starting to really cool down? Well, let's just look at the events that took place today. So the first thing we see is consumer confidence. Well, it went down, went from 106, the expectations for was 105, and it actually came in at 102. Don't really consider what the number exactly means. All that we're seeing is it's starting to lapse. It's starting to go down. All right. So you can see, if you see all the headlines here, you're seeing demand for new houses down 86%, home prices cooling, total mortgage demand sinks to the lowest level in 1997. Well, heck, my consumer confidence will be down if basically the world is crashing around us. Okay, so that's Monday's news. So that wasn't a shocker. Then we have new home sales. It was 677 was the previous reading. Now we're at 603. It's down. But don't really, you have to look at these numbers and put it in context, but we're starting that part of the year when you hit October, November, December, when we start tapering down on the robust, basically, housing market. Usually it peaks, in the summertime. And so January starts out, look at it this way. Here's how home sales go. January starts out, it's here, and then it goes way up by spring, and then it starts to peter out by the end of the year, and then it starts to cycle the next time around for the following year. So I'm really not hugely concerned with this, because it's that time of year where they start to kind of dry up, but we're going to monitor this closely. Crude oil inventories, they were way up. We were negative $1.7 million or 7 million barrels previously. Now we're in excess of 2.5. Some relief there. I'm not really sure if President Biden released oil from the reserves. I hope he didn't, but if he did, this may of what caused this. I'm not sure, but the good news is we have more oil in the system. Thus, we shouldn't have a huge spike in gasoline prices. Core durable goods orders, they're down. They were up 0.3. Now they're down 0.5. Basically, that's saying how much stuff is produced in the U.S. So if that is starting to dry up, then companies might start laying off. That's the scary part of this, because if you start getting laid off, then people might not have the income, and then that might snowball into, bad things happening. You might default on some loans. You might be in trouble financially. So, we want to be careful there. GDP, that's the next thing. We went off a previous reading of -6. It was expected to come in at 2.4. It came in at 2.6. Well, this number is going to get revised 2 more times. That's what happens. The GDP numbers come out initially, then they were going to get revised. Then I think they get revised a second time, and then a third time right before basically the government says, okay, that's the final number. So hopefully it's a positive. And then you might say, well, now we don't have 2 negative quarters of negative GDP, so we're not in a recession. Well, a lot of economists are still expecting a recession in 2023. Over 72% of them. So I don't think 72% of people are going to be wrong, but only time's going to tell in that part. And then the initial jobless claims. That's the scary part of this puzzle that we really need to focus in on. We were 214,000 was the previous reading. It was supposed to come in at 220. So you see the trend there, but it came in at 217, but it's still up. Again, this is jobless claims. You don't have a job. So there's more jobless claims out there that were basically published out there. And then we have the PCE from today. You see that came in right in line with expectations. So the market's doing pretty good right now. Let's go over and just see what the markets are doing. Let's just see right here. Let's see what the Dow jumps 400 points. So the Dow Jones loves this. Let's see how the mortgage-backed securities market is doing with this. They hate it. Okay, what they're saying is they're going to compile all this data and say, okay, the PCE came in, so now what's the Federal Reserve going to do? So as this number gets moderated and reviewed and everybody digs in on it this morning, they're going to revise things and they're going to really find out the major details behind this. So this is usually a really volatile day for the MBS market. We're seeing on the screen right now is what's happening to the mortgage bond that trades on Wall Street. This mortgage bond is basically the biggest component of your mortgage rate. So what happens in this, you can't really say, okay, it's down 67, so that's good. Well, no, what's showing on your screen right now is the price of a mortgage-backed security. So as the price goes down, there's an inverse relationship. So the price goes down, meaning inversely, rates or yields are going up. Well, if they go up, that means your mortgage rate's going to go up even more. So let's get over where mortgage rates are right now. This is a post by Mortgage News Daily on a daily basis. These are not my rates. These aren't any individual loan lender's rates. These are the national averages. And if you want to check this out, check it out down below. I have a link to this. It's free. You don't have to pay for it. If you do like the system I use, which is right here, if you're a realtor or a mortgage advisor, I would highly, highly suggest you use this. There is so much information and data on this form that it'll blow your mind. So if you want to also subscribe to this, I think I have a link down below that you can use as well and maybe get a discount. So check that out as well. But these are where mortgage rates are right now. You can see they're starting to come down. Okay, we peaked out about a week ago at 7.37 on the 30-year. Now we're down about 0.25% on that. So that's a good direction we're taking right there. And here's the rest of the rates across the board. You can check those out. And you can see the tendency right now is they went down yesterday, but today, because of this, we're going to see a rate increase. If this holds steady, we'll probably see rates go up 0.25, basically back to where we were about a week ago. So that's, hopefully that, I didn't want to bring up bad news for you guys on a Friday, but that's what's going on there. So why are you here? Well, it's this. But if you want to check me out and find out all this detail and you want to find me on podcast, check it out. We're even on Apple Podcast right now. So whoever you use for your podcast, just look us up, The Mortgage Update with Dan Frio. Hopefully you'll find us there. If you don't, let me know. I'll try to subscribe to that system. Another system that we created, this is my little infomercial at the end of this, just to help those out there that are looking to maybe buy their first house. How do you get prepared? How do you prepare yourself for the spring market? Well, the first thing is, the one big thing you can control is your credit credit. So to check out what your credit scores are, you can go to creditscoresandmore.com. I actually created this site just for you guys. Most of the services are free. There are some paid services, but the one thing I would ask you to do is go into this system and use the free credit scoring system. It's a fantastic system. There is no cost. If they want you to upgrade your subscription, don't do it. Just use the free services. It's more than enough that you're going to need. Okay, but if you want to find out more about me and my team, here it is. Go to therateupdate.com, and here's a whole bunch of information for you guys out there. But what I want to ask you to do is we just added a new free service, and it is right here, the loan estimate. What is a loan estimate? Well, let me explain it to you. When you go out and get, you call a mortgage lender and you're like, hey, I need to get it pre-approved, or what kind of rates do you have and everything? What they have to do is actually start your mortgage application. If they do that, they have to send you what's called a loan package. In that loan package is your loan estimate. The loan estimate explains to you everything. It gives you the purchase price of the house or the value of the house, the loan amount, the interest rate, all the fees, is it locked, what kind of loan it is. It gives you everything. So it can provide me everything. So why? Why do I ask you to send it to me? I'm a mortgage broker. I'm actually a bank, but we act as a broker on a federal charter license. So that means we can help you anywhere in the country as well as Puerto Rico. So how can you get your loan estimate compared to over, you want to get it compared over one person, maybe two. People say always get, 2 or 3 quotes. Wonder if we can get you 85 quotes with just one system. That's me. What we do is we scan your loan with over 85 of the country's largest banks and mortgage companies to find you the best rate and fees out there, and to also assure that we put you into the right program. So how do you do this? Well, if you have a loan estimate already from another bank or lender, just go into my website, click here, it's a loan estimate, fill out these details, and the biggest one is right here, because I know a lot of you guys don't want to get pestered, you don't want us calling you and hounding you, so let us know right here how you want to be contacted. Okay, but fill out the rest of the screen, and then what you're going to do is drag and drop your loan estimate right in here. It's going to populate on our side in a secure system. What we're going to do is give us an hour or two. We're going to review all that information with all the lenders out there and get back with you quickly to ensure you guys are getting the best rate in the markets. So that's what we do. So if you'd like to find out more about me and my team, just visit us at therateupdate.com. We'd love to hear from you. So you can book a meeting right over my head. On the other side of me, over here is the phone number, and then there's tons of data here to help provide you guys as much information as I can when it comes to getting a mortgage. So that's it for today. God bless you guys. Have a fantastic weekend. Don't forget to give us a thumbs up, subscribe, and hit the bell every time I post a video. You get an alert. Take care, guys. Love you. Have a great weekend. See you Monday. Bye-bye.